Power Finance Corporation, a giant NBFC with a vast potential for value to be unlocked. PFC, a central PSU with a massive market capitalization supported by an earning pool of over rupees 30,000 crore. Government is the majority shareholder, followed by institutions who in aggregate hold almost 35%, funding the entire value chain of generation, transmission and distribution of power. Now diversifying into sectors of infrastructure and logistics, and also aligning with the government focus on environment friendly non-fossil energy. PFC operates through a set of subsidiaries and special purpose vehicles set up for unique projects. REC, a 53% subsidiary, is a very prominent player contributing to the consolidated profit pool almost on par with the PFC. PFC and REC have their exclusive dedicated sectors for their business operations. They both work together as nodal agencies on governmental initiatives. There is, however, competition between the two in funding infrastructure and logistics projects. Prominent among its peers are IRFC, HUDCO, and IREDA, who have a strong market standing. A rising loan portfolio with an impressive 5-year CAGR. Net NPA moving down the slope, highlighting stronger provision and minimum uncovered risk. Constant fall in gross NPA, being absolute amount of non-performing loans, is reflecting better financial health. Both indices being very positive highlight exceptional financial strength of Power Finance Corporation. Equity build-up from rising profits and a strong plowback. Assets have maintained a healthy growth rate. Rising equity percentage over years is indicative of growth in net worth in excess of asset growth in an ascending trajectory, and that facilitates strengthening of capital adequacy ratio. PFC is in strong financial health, complying with the RBI prescribed adequacy norm of 15%. Volume of consolidated profits move beyond rupees 30,000 crores with an impressive 5-year CAGR in excess of 25%. Average growth in annual profits settles at around 18% with a low of 12.8% in FY23. Profitability is in an ascending trajectory, moving steadily and closer to 29%. Very positive growth features in volume of profits and profitability as well. A gradual improvement in ROA reflecting healthy usage of assets and reaching a comfortable 2.8%, helped by strong asset quality and operational efficiency. Return on equity maintains a stabilized level of 21%. The rewarding ratios reflect a successful synergy between financial discipline and operational leverage. With prices falling substantially from its recent peak, the dividend yield has been rendered more rewarding, being at a level between 3.8% and 4.7%. That's quite attractive, particularly to investors with income focus looking for higher yield. Quarterly standalone net profit for its movement across quarters makes an interesting study. While the volume of profit on a quarter on quarter basis for Q2 26 has shown a growth of just 2%, down almost 20% as compared to the 3 quarters in the immediate past. The fall in volume growth has pulled down the net profit percentage for the quarter by over 2.5%. The unexpected damage is from margin pressures, higher operational costs, and impairment provisions. This has sent a wrong signal to the market. From early 2023 till mid 2024, over 18 months, PFC had the unique distinction of outgrowing Nifty. During the period, the share price rose by about 5 times from 100 to 580. Then ensued the fall from the peak of rupees 580, incessant fall for another 18 months till December 2025, losing almost 42%, a collapse in spite of performance figures remaining quite impressive all through the period except in Q2 FY26. The share price had crossed over downwards in January 2025, slipping into bearish zone proper. It moved sideways in consolidation over an year, and currently it has moved below all moving averages, enveloping the lower range of Bollinger Band for over a couple of months. The current price level has reached the state it was in 2 years ago. There appears no firm indication of any change in direction for the present. The share price of PFC is currently at a very subdued level. The price earning multiple is at its low in 2 years. So also is the book value based multiple, which indicates that the current price is even below the book value. The share is valued quite attractively, both based on earning multiple and book value multiple. It might be worth waiting for firm indications on long-term direction before any decision. Strong positives: increasing loan book in renewable energy sector aligning with the government focus, incremental power demand from adoption of electric vehicles and expansion of data center, RBI's decision to reduce risk weights on NBFC lending to infrastructure is an opportunity. Poor health of state distribution companies enhances the risk. Vulnerable to changes in interest rates affecting net interest margins. Caution on global uncertainties impacts the market demand and also decides investor sentiment. Hope this video on Power Finance Corporation was to your liking. I am Vittal Prabhu with the fortnightly video on Stock Learning Simplified. You might like to access more quality videos with us. Your feedback and support helps us raise quality of our delivery. Highly obliged for your time, interest, and valuable inputs. This video is for purposes of information, education, and awareness only. This is not meant to be a solicitation or recommendation to buy, sell, or hold securities. Wherever applicable, please seek the advice of a competent professional before taking action of any kind.